All right, ladies and gentlemen, you are welcome to our class on impairment of fixed assets, or NCA. This is going to be a very short class, but a very knowledgeable and insightful lecture. So we want to look at impairment of fixed assets. So as we do always, the first thing we do is to actually get the definition of what we are doing. Because like I always say, the definition will help you to know that, this is impairment, all right? So that is that. So when we talk about impairment, what are we dealing with? Impairment of fixed assets, what are we dealing with? Now, impairment is simply a reduction in the recoverable amount of an asset, all right, or a cash generating unit, so that the thing will come to how much it is actually worth in the real market, not how much it is standing in your books. So we are talking about the reduction in the carrying amount of an asset or a cash generating unit below its carrying amount. All right. So basically, that is what an impairment is. So impairment is the reduction in the recoverable amount, not of the recoverable amount, in the recoverable amount. All right, of an asset or a cash generating unit, which we normally refer to as a CGU or an SBU, all right, below its carrying amount. So that is the definition that is given by the IAS 36. So that is basically it. So we have CA, carrying amount. Here you have RA, which is what? Recoverable amount. So take note of that. All right. So that is what impairment is. So when we talk about a cash generating unit, we are talking about the smallest unit of an asset, all right, or of an entity that can generate cash flow on its own. Okay, so the smallest unit of an entity that can actually generate cash flow on its own. I will cite some example for you later. So when we talk about this cash generating unit, so look at Accra Mall as an example. You see that Accra Mall, you see the more big as it is, all right, as an asset, a whole big building. But inside the mall are individual shops, okay, and those individual shops generate cash flow on its own. You could even realize that they prepare their own financial statement and determine their own profitability. So that is what we call what a cash generating unit. Okay, so when you see when you see it mention it anywhere, a cash generating unit is just talking about the smallest identifiable group of assets, smallest identifiable. I mean, when we say something is identifiable, we've learned in IAS 38 that it means it can be what? Separated. So the smallest group of an asset that can be separated, all right? So identifiable group of an asset that generates cash and, all right, so that it generates cash inflows that are largely independent from the other assets. All right, separated from the other asset. Independent from the cash inflows of other assets. So if you go to the Accra Mall, for example, the cinema attracts a cash inflow from it on its own, separated from the other shops, all right, that you see in there. So that is what a cash generating unit is about. We all know, I think for assets, we all know assets. All right, so that is what impairment is all about, okay, a reduction all right, when the value starts falling, dropping. Now, the basic principle in impairment is that an asset should not be carried over and above their recoverable amount, all right, over and above their recoverable amount. So that's the basic principle, and that is the underlying factor that you should know, all right. So it is saying that an asset should not be carried or recorded, all right, over and above their recoverable amount. So you can't put in a figure in your financial statement that is over the amount that you can actually recover for the asset. I mean, if in the market, your asset, let's say your phone, is costing right now, a phone that you bought, let's say you bought it for 5,000 Ghana cedis. But right now, as we talk, relevance, don't forget, this is historical cost. Relevance is that now the phone is actually 3,000 Ghana cedis. You cannot record the value of the asset in your book over and above their recoverable amount, which means that you cannot record this. This is what you can record, and this is the recoverable amount. So you have to record 3,000, but the thing is actually 5,000. That tells you that there is an impairment of what? You have to impair the asset by 2,000 Ghana cedis so that you can actually have it, all right, at the recoverable amount. Okay, so that is that. So that is what we mean by it. So mathematically speaking, and to make it easier for you, whenever you want to check out on impairment, the formula that you have to go by is that when you want impairment, all right, impairment is given by situations where the carrying amount, all right, the CA is greater than the recoverable amount. The recoverable amount, how much you can actually get from the asset, how much you can actually get from the asset. So if the carrying amount, the value of the asset in your book is greater than how much you can get from the asset, then it means that there is impairment. Now let's look at this and break it down a little, because when we talk about carrying amount, I think for now everybody knows what carrying amount is, all right, because it comes from the cost model where you will need your cost, you will less accumulated depreciation, then the current year's depreciation, or so it can be depreciation or amortization, whatever it is, all right. If it is an intangible, we use amortization. So the current year's depreciation or amortization, all right. So you less all and you get what? Your carrying amount. So that is how you get carrying amount. All right, take note of that. All right, now let's talk about the recoverable amount. We said that the recoverable amount is the amount that you can get from the asset. But there are two ways you can get the amount from the asset. Number one is that I can sell the asset and get some value. All right. And number two is that I can use the asset myself and the asset will be generating cash flow for me in future. All right. So there are two ways you can get the recoverable amount. And therefore, the standard says that the recoverable amount is the greater of the value in use, VIU. And we did this in IFRS 13, conceptual framework and IFRS 13. We call this one VIU, the value in use, and fair value less cost to sell, which people normally refer to that as the net realizable value, less cost to sell. So that tells us that if we want to get impairment, then it means that we need to find three figures. We need to find three figures. What are the three figures? We need a carrying amount. What else do we need? Okay, we need the the value in use. What else again do we need? We need the fair value less cost to sell. These are the three things we need to be able to calculate our impairment. All right. So now, how do we measure our recoverable amount? How do we deal with that? So let's talk about value in use. What is value in use? Value in use is the present value, and watch it carefully, the present value of the future cash flows. Present value of the future cash flows expected to be derived, all right, from using the asset. So this one, you don't sell the asset, you use the asset. So let's say I have a car, I have a carrying amount of the car. Now I want to measure the recoverable amount. The recoverable amount is measured as the greater of what? The value in use and what? The fair value less cost to sell. Now, if I'm going to use the value in use of this car, then it means that how much am I supposed to be getting if I use the car myself? And how much will I get if I sell the car? All right, so that is that. So how much do you get from using the asset is the value in use. Now, in this value in use, what you should know is that is the present value of the future cash flow. Present value of the future cash flow. All right. So what you need to understand is that you do PV of the future cash flows. And please, let me give this important message because people tend to omit that. If you have done financial management before, you realize that when you are PVing something, there are certain things you need. You need a discount factor, you will need a cash flows. And sometimes there is what we call residual value cash flow at the end of the project in FM. And so here too is the same thing. What you're going to do is that you have the future cash flow here that we are talking about includes the residual value. It includes the residual value. Take note of that. It includes any residual value of the asset or scrap value or whatever you want to call it. Again, like I said, you will need the cash flows, all right? And now the cash flows that you are going to use, the cash flows, the future cash flows, this one, the future cash flows are supposed to be pre-tax future cash flows, all right? Pre-tax, not post-tax. And I have an explanation for that, all right? It's supposed to be pre-tax. Why? Because in financial reporting and in corporate reporting, tax has a standard on its own. All right, tax is not just a 30% of your profit. No, it's not like that. So that is why here you have to use pre-tax cash flows because there is a whole IAS 12 that deals with what? Taxation. So when you are doing this, you need pre-tax cash flows. All right. And don't forget, these are cash flows that you have estimated to be deriving. All right. And so therefore, the derivation of those cash flow must be based on reasonable assumption. It must be based on reasonable assumption. So check the question because they can give you so many assumptions for the cash flow if the examiner wants to, and you have to use the one that are based on the best and reasonable assumption. Okay, so it must also be based on most recent budgets, the most recent budget, all right, and forecast based on most recent budget, not some old budget, recent budget and forecast. All right, it must be based on such because we want the thing to be what? Reasonable. Okay, so that is that. So these cash flow, like I said, are pre-tax. And so when I say it is pre-tax, then what we are saying is that basically it excludes financing activity, income tax, and any enhancing and improvement, all right, activity. So it excludes tax, income tax. So I've already said that. All right. Again, I'm also saying that it must exclude financing activity. And so the discount factor is the issue, and I'm going to talk about it. All right. Financing activity and any enhancing, all right, or any improvement. Because we want you to give us the value from using the asset as it is. All right. So take note of that. Not that you are going to do some body works on the car and the cash flows will change. No, we want it to give it to us as it is, enhancing and improvement. So it actually excludes all those things. It excludes tax, it excludes financing activity, and excludes any improvement. Now, the standard says that the forecast that you are going to use, the future values, all right, that you are going to use, the future cash flows, should be limited to 5 years. And that if you are going to go beyond 5 years, if it is beyond, if you are going to use cash flows beyond, if the future cash flows will go beyond 5 years, and please, these are things you need to know, because the examiner can test you any way around it. If the cash flows are going to go beyond 5 years, then the management should extrapolate a decline or a zero growth. All right. Management should extrapolate a decline or zero growth. These are hidden details in the standard you may not be, privy to. All right, it happens. It happens. All right. Now, what are we saying? So let's say year one. Let me give you some example here. Let's say your year one, so you are in year zero. So your future cash flow starts in year one. You have year two, you have year three, you have year four, you have year five. So you can have here as 10,000, 20,000, 30,000, 40,000, and 50,000. That is fine. It's with 5 years. But if you're going to go beyond 5 years and go to year six, you can't go on with what? 60,000. Because the standard says that you should extrapolate what? A decline or zero growth. So it can be from 6 years going should be 50,000 and below. All right. So that is how it has to be. All right. Zero growth means that it is constant. All right. Or extrapolate a decline. So that is what it means. All right, so that is that. Last but not the least, the other thing you have to take note of is the discount factor that you are going to use to do the PV. The discount factor. And please, the discount factor should be risk-adjusted discount factor. All right, so it should be risk-specific, i.e., you have to talk about time value of money. It should be risk-specific or risk-adjusted. All right, risk-adjusted. And therefore, all right, so we are saying that it has to be specific to the asset. All right, specific, risk-specific to the asset. All right, to which the estimate has not been adjusted. All right, so risk-specific to the asset, not the general company, but just to the asset. And you know that the one specific to the asset, we are talking about the cash flows that are pre-tax. And therefore, the discount factor also, you see, you have not adjusted it for all these things. And so the discount factor also should be what? Pre-tax. So please take note of that. It should be pre-tax. All right. So ladies and gentlemen, that is something you need to know about the value in use. Okay, so that is it. Something you need to know about the value in use. Now, as for the fair value less cost to sell, you've understood the concept of fair value, IFRS 13 fair value, which means that there is a concept of what? An active market. All right. So that is that. You need an active market. And you will less what? The cost to sell. Okay, so that you get the net amount that you realize. All right. So it is the price, all right, that you would exchange an asset for in an orderly transaction between market participants at a measurement date. You know that, all right? And so what we are saying is that there has to be a binding agreement. That's the fact that in an active market, there has to be a binding agreement. It's very, very important. And again, these aspects also excludes what? taxes and finance costs. Exclude taxes and finance costs. Take note of that. All right. So that is what you need to know about. So all you put in all these things, all right, fishing out these things in the case to get the figures, all right. So that is that. In any case, you have to understand that according to the standard, you have to be testing for impairment. So there are some indications on impairment. So we talk about indicators of impairment. Something will happen so that you know that your asset, all right, is impairing. Indicators of impairment. Indicators of impairment. We have the internal sources of indication, and we have external sources. All right. So in your exam, whilst you will be seeing such sources or such statements concerning the asset, then you realize that there is a call for impairment in the asset. All right. So internally, what you see there is that whenever there is obsolescence or a damage, then it means the asset is going to lose its value. There is impairment. All right. Number two, if there is a material reduction in the use of the asset, a material reduction in asset usage, you realize that that one too is going to cause the probable benefit that you would derive from the asset to come down, and the asset itself will be losing its value. All right. So therefore, we say that the reduction in the economic performance of the asset, all right, reduction in the economic performance of the asset. All right. So that is it. That is it. All right. Those are internal sources. All right. Externally, you can see a decrease in the market value of the asset. When we do IFRS 9, we will talk about impairment in receivables and financial assets. Okay. So decrease in market value here of your asset. All right. Change, an adverse change in PESTEL. You know PESTEL? Yeah, political, environmental, technical, social, and all those things, legal factors that affect you. So adverse change in the PESTEL, your environment. All right. High interest rates can cause your asset value to come down. And if you are in Ghana at this time, these are what we are going through. Tough time. All right. Because when you are doing the PV of your cash flows, you realize that if your discount factor is higher, your values will be low. All right. So that is what is going to happen to you. All right. So the PV. All right. Lastly, when your carrying amount is greater than the market capitalization, your market capitalization, you realize that the asset is being impaired. So the standard IAS 36 says that every year you have to check out from these sources. All right. If you have these things happening to your asset, then it means that you have to test your asset for impairment. It means that you have to test your asset for impairment. But if you don't have it, if you don't have these signs, there is no need to test for impairment. So is there indication? The key is this. Are there indications? If your answer is yes, then you test for impairment. All right. Are there indications? If your answer is no, then no testing for impairment. However, there are three conditions where even if your answer is no, you have to still test for impairment. There are exceptions to this no, and these things are normally examined in your FR exams. So you have to take note. There are three conditions for that. Even if your indication is no, then still you have to test for impairment. So that number one is goodwill acquired. Goodwill acquired in business combination. So you see that when you are doing your consolidation, you always test for impairment, all right, business combination. So we will do that when we get to consolidation. So please take note of that. When we get there, be reminded. Number two, we have intangible assets without a finite useful life. So in our lecture in IAS 38, we said that when an intangible asset is without a finite useful life, you test for impairment. But if it is with finite useful life, what do? You amortize, all right? Okay, so that is that. And you can even test for impairment for that one too. Who knows, given the question. So what you do is that you have to understand that IA, intangible assets, without a finite useful life, is also tested for impairment. All right, even though there is no indication, it's still tested. And lastly, an intangible asset yet to be made available for sale, or not yet available for use. So intangible asset not yet available for use. And please, these three things, if you are writing an FR paper, you have to take note of that because it is highly examined. All right, so please, that is that. Now, when you test for your impairment loss, how do you treat the impairment loss? The treatment of the impairment loss depends on whether it is a CGU or it is an asset. Because when we are discussing impairment, we've looked at it from the perspective of a CGU and an asset. Now, so what you do is that when you get your impairment loss, so for a one asset, not a CGU, so an asset, the impairment loss, all right. So let me say the treatment of the loss is the same anyway, but how it affects your carrying amount is where I will do what do we call an apportionment, all right. So the impairment loss, okay, goes to the what? SPL. It goes to SPL unless and those things you remember them in IAS 16, all right, unless the loss reverses a revaluation what gain in the OCI, all right. All right, so take note of that. Okay, so in such a case, you see that the OCI surplus will be reduced by and any excess, all right, will go back to goes to the SPL, all right. So basically that is that. But in your SOFP, you know that you have to reduce the carrying amount of the asset so that it reflects what the recoverable amount, so that you can continue with your what amortization or depreciation. All right. So this one is a debit. All right. So you credit the asset. All right, to reduce the CA to the RA. All right. So as simple as that. But when it is a CGU, what you're going to do is that you are going to actually apportion the impairment. So in a CGU, you are going to share the impairment loss among the various smallest units of assets. So how do you do the sharing? First one, you have to apply the impairment loss on a specific asset. All right, specific asset that has suffered more on the impairment. All right. So let's say, and this is academic, all right, not that I'm praying for it to happen. Let's say Accra Mall is bent. You see that some shop will be bent totally. Some may not be. I mean, so some to half will go and all those things. So when you are sharing the impairment, you realize that there are certain specific assets that have gone totally. So those ones should go. All right. So you first share with specific assets that have suffered under the impairment. Then the next thing you do will be the goodwill, because the integrity of Accra Mall will be gone. So the goodwill, the purchase goodwill, all right, the purchase goodwill. So you knock that one too off. Then if there is any balance, you are going to spread it on the other assets. All right, you are going to share it on the other assets, or the other assets, okay, all right, proportionately. All right, so it is the remaining that you are going to share proportionately on all the other assets. All right, so take note of that. In any case, in case you have to reverse the impairment, you have to test the market if there is a need for you to reverse the impairment. Okay, so if you are going to reverse the impairment, please understand that the goodwill, if you spread the thing on the goodwill, the impairment on goodwill can never be reversed in subsequent period. All right, this one can't be reversed. It can't be reversed. It cannot be reversed. And you can only reverse an impairment amount, all right, to the maximum of the depreciated historical cost. All right, so that is that. That is that. So if you treated the impairment as a loss and you debited your this thing, your P&L. If you are reversing it, it means credit your P&L. It's as simple as that. And the asset that you credited, you have to what? Debit it back. That when you are debiting it back, you see, we are saying that the asset might have been depreciated, all right, with a lower amount. When you took the impairment out, you depreciated the asset. And so if you are bringing it back, then it means that is why we say that you can only reverse the impairment to the maximum of amount of the depreciated historical amount based on the original historical cost. That is what you can do. All right. So that is that. Now let's pick up examples and do this mathematically, or as it would appear in your exam. So that is that. So let's look at some examples. Let's look at some examples. Yeah. All right. So let's pick this example. And these are past questions. I think this is July, question 3, July. So let's look at that. July 20. This is corporate reporting, July 2023. All right. So let's look at the question. It says that Sando is a company which manufactures manufactures machinery for industrial use and has a year end of 31st December 2021. The directors of Sando Limited requires advice, all right, on the following transaction. So what do they need? They acquired a cash generating unit for several years ago, but as 31st December 2021, the directors are concerned, all right, that the value of the CGU has declined because of the reduction in sales to new competitors, due to new competitors in the market. Now, at 31st December 2021, the carrying amount of the CGU is what they've given us. So we have the carrying amount. And don't forget, in impairment, what we are looking for are three things, right? We need a carrying amount. We need what again? Yes, you are right. The value in use. We also need what? Fair value, what? Less cost to sell. So these are the things we need. Now, we've been blessed with a carrying amount. So we know the carrying amount. What is our carrying amount? Our carrying amount, we have PPE here, which is 20 million. So our figures are also in millions. We have 20, we have goodwill of 6. Then we have other assets. Other assets of 38, and that gives us a carrying amount of what? 64. All right, hallelujah. We have that. Now it says that the fair values of the PPE and the other assets were 20 million and 34 million respectively, and their cost to sell was 200,000 and 600,000 respectively. The CJU cash flows for the next 5 years are as follows. Okay, so this one can help us with the fair value less cost to sell. Is that not it? Yeah. So that is that. So fair value less cost to sell. We are told that the PPE is how much? The PPE costs 20 million, right? The fair value is 20 million. Less cost to sell of how much? 0.2 million. That is 200,000. And how much will we get for that? So punch calculator. So that one will be what? 19.8 AR. So that is that. We have that. 19.8 million. All right. So that is that. Let's pick calculate. Then we also have, it says the other assets. Other assets. We have, how much is that? 34 million. And what is the cost to sell? 0.6 million. So we have 34 minus 0.6, and that gives me 33.4 million. So it means my fair value less cost to sell will be what? The total that I have here will be 53.2 million. All right, so that is it. I have my fair value less cost to sell. There's one thing left. What is left is the VIU. Is that not it? So we will need our VIU. So let's work on our VIU. So what is the VIU? So the question said that what do we have here? The CJU has cash flow for the next 5 years. So 5 years. We have pre-tax cash flow and post-tax cash flow. So this is the trick for you. Some students will be in dilemma as to which ones to use. All right. And it also says that the pre-tax discount factor is 8%. Post-tax discount factor is 6%. So we will need the discounting factors. You can read from your PV table. But the discount factor, you can always calculate it yourself. It's 1 over 1 plus R raised to the power N. All right, you can do it yourself. You can be calculating it for each year. So if it is year 1, N is 1. If it is year 2, N is 2, like that. And you use it to PV the cash flows. All right, so that is how it's going to be. You use it to PV the cash flows. All right, but here we have been given. But the trick here is that, you see, they gave us pre-tax cash flow of 8% and post-tax of 6%. You see, the pre-tax is here, post-tax is here. But when it comes to the discount factor, the post-tax has come here, and the pre is here. So the examiner is just trying to play with your mind. So if you know your standards, you know that, for me, I don't mind. All that I'm using should be what? Future cash flows that are what? Pre-tax. So you scrap this. This is not useful. This one is not useful. The pre-tax, the post-tax 6% is also not useful. That's all. That's all. Cancel it out. In reference to the relevant standard, I think they want us to advise. That is always what your question is about. You always be meant to advise, yes, and it is 10 marks. So you see, it's very, very easy. It's very, very easy. So, I mean, sometimes the examiner brings things just to trick those who have not learned. All right. So what do? We have 2022, 2023, 2024, 2025, 2026. Now, if this thing had exceeded 2026, don't forget they should what? extrapolate a decline or a zero growth. All right, so that is that. So I can continue this question and add 2027 and give you two figures, a figure like 25 and 27. You can't use the 27 because the per standard you should extrapolate a decline. So that is that. So you have to be ready, okay? The examiner is always tricky. All right, so here we have 16, 14 million, 10 million, 6 million, and 26. The discount factors we are using will be this one multiplied by 0.9259, multiplied by 0.8573, multiplied by 0.7938, multiplied by 0.7350, multiplied by 0.6806. When we do this, how much are we getting for our VIU? Because we need a recoverable amount and we need to pick the greater of that and the fair value less cost to sell. So let's do it. 16 multiplied by 0.9259 gives me 14.81. It is 8144, but let me make it just 81. All right, or I can add a 44 to it. All right, then we have 0.8573 multiplied by 14, and that gives me 12.0022. Okay, then the next one is 0.7938 multiplied by 10, and that one gives me 7.938. Then we have 0.7350 multiplying 6, and that gives me 4.41. Then the last one is 0.6806 multiplied by 26, and that gives me 17.6956. If I add all these things together, how much am I getting? So I have the 17 plus 4.41 plus 7.938 plus 12.0022 plus 14.8144, and that gives me 56.8602. So like 56.86. All right, so that is that. That is what I have. All right, now we have the figures. So I think it should be easier for us to pick the greater of the two. It should be very, very easy for us. So what are you going to do? It means we need to pick the greater of the two, and this one seems to be greater. And so therefore, my impairment is going to be, so we have impairment, CA being greater than RA, where the CA is what, 64, then this side is what, 56.86. So it means impairment is how much? Impairment is like 7.14, right? Is that correct? All right, so that is. So now that we have our impairment, what do we do? And don't forget, this was a CGU. And for a CGU, we are going to, this is an impairment loss, of course, it will go to our SPL. All right, because there is no reversal, it is not reversing any revaluation surplus. But the SOFP, how do we do it? We are going to share this among the assets. Do you remember what we said? We said that first to what? A specific asset that has been completely gone. Then the next to what? Goodwill. Then the other one is what? Other assets. I think this question is a little tricky, and because we don't have any specific asset in this one, like a specific asset that was first attacked by the impairment loss. We don't have. So specific asset is 0, but we have goodwill, and the goodwill is how much? So the goodwill had 6, right? So which means that we are going to share this one out of it, which means impairment loss and our recoverable amount, the impairment loss, and don't forget this is CA. So we will have the PPE that you see there plus the other assets will form the other asset that we'll be sharing the thing on pro rata basis for. All right, so this side should be what? We have 20 plus 38. So that gives us what? 58. So that gives us our carrying amount. And we have impairment of what? 7.14 million. All right. And the recoverable amount was what? 56.86. So that is what we should be doing, 58.86. Is it 56 or 58? Let's go and check. It's 56.86. So 56.86. So that is that. But we have to knock off because goodwill is the next. So here is 0. Then we have to share the remaining 1.14 on pro rata basis. How do we share that? We will have to share it because the PPE part will be what? The PPE is 20, so it will be 20 over 58 multiplied by the 1.14 that we have to share. Then the other assets together, there's no breakdown. So that one is what? 38 over 58 multiplied by what? 1.14. How much are we going to get for these? Okay, so that is how you share. So you share the PPE, you share, even though I've combined it here, all right, that is how you share. So if you separated the 20 and the 38, you give each thing each one their respective amount. All right, so this is how the sharing is going to be. So that means that the PP is having what? 20 out of 58 multiplied by 1.14. The PP side is like 0.39. And if you take that one from 1.14, it means that you end up with 0.75 for this one. All right, so that is the sharing. That gives us the total of this. And so when we do that, how much are we getting? We have 56.86. 56.86. So that is it. So this one will go to the SPL, but in our NCA in the balance sheet, this is how it will appear. All right. So the PPE, if we did that, if we separated it, this one gave us what? 0.39, and this one was what? 0.75. So if we are recording those things in our SOFP balance sheet, you realize that, yeah, goodwill is the intangible. It is 0, so nothing will be recorded. Then the next thing will be what? Our PPE. So PPE, we will be having 20 minus what? 0.39, which is how much? Which gives us 19.61. So that is what we will be recording. Then the other assets, it can be non-current, current assets. It could also be non-current assets. So we have 38, you are taking away 0.75. All right, my guess is that that should be 37.25. All right, so basically that is that. All right, that's how you present it. So this is how you do it in the concept of CGU. All right, hope it wasn't anything difficult. It's 10 marks, so you are likely to spend a little of time on that. Let's look at some other 2 questions and we can bring this lecture to a close. This is this is what we've gone through. All right, so let's look at some 2 questions here that has dropped before in your FR paper. All right, but as a corporate reporting student, you need to practice from beneath the FR. All right, so that is that. Now, this one says that Ayariga Limited acquired a head office in January 2007 at 10 million, excluding land. The company depreciation policy is to depreciate property over 50 years on a straight line basis. Estimated residual value is 0. On 31st December 2011, IARIGA revalued the non-land element of the head office to 16 million in accordance with IAS 16. That's a revaluation model, right? All right, and has decided not to transfer annual amount out of revaluation reserve. So that is something we learn under IAS 16, excess depreciation. Don't forget that. It says that this company doesn't do that. In January 2017, a storm damage occurred, and the recoverable amount of the head office, excluding the land, is 5.8. So you see, we need 3 things. What are the 3 things? CA. We are preparing this thing as at when? January 2017 first. It's as good as telling us it is what? 31st December 2016. All right. So now, the cost of the assets is 10 million. What will be the accumulated depreciation? Accumulated depreciation. So we are told that it is 50 years. So 10 by 50, what is going to happen? So that gives us depreciation every year of what? 0.2 million. All right. So that is that. All right. Okay. So now, how many years to the time we are looking at this? How many years? Okay, so they revalued it on 31st December 2011. So it means that from 2007, 2008, 2009, 2010, 2011, that's like 5 years. So if you multiply this one by 5 years, it grants us our accumulated depreciation. And that is 1 million, right? So we get our accumulated depreciation. And what do we have here? We have it like 9 million. That's it, right? Yeah. Okay. Now it was now revalued to 16 million, which means that there is a revaluation surplus of how much? 7 million, which will go to what? The OCI. All right. So we've used 5 years out of the asset. Okay. So that is that. So you had 10, it was for 50 years, and 5 years gives us 1 million. So this revaluation has happened. So this one becomes our new carrying amount, all right, for our impairment analysis. Then we are told that this one, that we are supposed to do this thing at and January 2017. And the revaluation happened when? 2011. So we need to continue with the depreciation. Now, when asset is revalued, we continue what? Depreciating it using what? The subsequent useful life. So now the useful life is now 45 years. Is that not it? So how do we get depreciation for this 16? So we have 16 dividing it by 45 years, which means every year gives us 0.35. All right. So we started. So we have what do we call it? 2012, 13, 14, 15, and 16. So that one too is multiplying 5 years. So that is that. And that gives me 1.78 rounded. So that the new accumulated depreciation for that is this. So if I now take it from the 16, it means I'm landing at a figure of what? 14.22. All right. So this, we could have done excess depreciation, you remember, but the question says they don't do that. All right. So that is that. Now, what do? We have the final carrying amount, and the question told us that the recoverable amount is what? 5.8. This is serious, and therefore there is a huge impairment. All right. So what will be the impairment? The impairment will be something like 8.42 million, which will be going. So we will record this one as the one in the SOFP, because that is the recoverable amount now. And this one will be to the SPL, i.e., we are crediting this figure to end at this figure. So you see, it's tricky. All you need to know is the concept. So if you are calculating carrying amount, you know carrying amount. It's as simple as that. Know how you get your carrying amount, know how you get value in use, know how you get fair value less cost to sell. As simple as that. All right, let's look at the last question. Look at the last question. So the last question, what happened? All right, so we are supposed to talk about impairment, and there is a plant. Divine Education acquired a plant at cost 800,000. So we have the cost. It's the same thing, three things we are looking for. So we have 800,000 on 1st April 2016. Let's see the accounting year end of this entity. We are supposed to be doing this thing at 30. Okay, so it means that it's 31st March, meaning that the accounting year always starts at what? April. All right, so that's fine. The estimated residual value is 50,000. So be mindful, residual value is what? 50,000. This residual value, do you remember when we were talking about VIU, we said the residual value should be part. Don't forget that. These are the tricks in the exam. All right. 5 years useful life. All right. And so we are told that Divine Education uses straight line method. So it means we can calculate depreciation by doing 800,000 minus 50,000 cost minus scrap all over what? Useful life, which gives us how much? So we will have 750,000 divided by 5 years. Is that not it? Which means every year gives us what? 150,000 cedis. All right, so that is that. We put that down, and they said that on March 31st, 2018, Divine Education was informed of a major customer who buys products produced by the plant that it will no longer be placing an order. That is a sign of impairment. The sign of impairment. With Divine Education Limited. Even before this information was known, Divine Education had been having difficulty of finding work for the plant. Do you remember? Reduction in the economic usage of the assets. So that is that. It's a sign of impairment. It has now estimated a net cash flow and from the plant. Okay, so these are what we have, the cash flows. And this, you have been blessed with the cost of capital, and this is it. So it means we are going to do what? VIU, all right? So what is the carrying amount? How many years are we looking at this? It's just 1 year. And so if we have depreciation, if we take it from the cost, our CA will be how much? So CA will be 800,000 minus 150. And I think that gives us 650,000. That's it, right? So you have that as your CA. So it means our next job is to go on to find our, so this is depreciation for 1 year, and we are told that this thing was bought on what? 16, and this is March, which means that it should be how many years depreciation? April 1st to 31st March 17 will be 1 year, then another one. So it means this side actually should be multiplied by 2, which gives us 300,000, right? So that is it. Multiply by 2, which is 300,000. Therefore, our carrying amount will be what? 500,000. So that's that. Then we come to our VIU. It looks as if we didn't have any fair value less cost to sell in this question. So it's the VIU we are using. So we have the future cash flows 2019, 2020, then 2021. So what are the cash flows? Cash flows here is what? Okay, we have 220,000. We have 180,000. Then this one is where the trick is. It is 170,000. Don't forget, residual value is part 50,000. And that, when we combine it, this side will be giving us how much? 220, right? All right, so that is that. And that is the trick you have to always be careful about. So if we apply our discount factor 0.91, apply 0.83, apply 0.75, what are we getting? So let's punch the calculators. All right. So I have 220 multiplying 0.91, and that gives me 200,200. So it's like this. All right. So that is what I get. Then the next one is 180,000 multiplying 0.83, and that gives me 149,400. And the last one, which is 170,000 plus the 50,000, giving me 220, multiplying what? 0.75. And that gives me 165,000. So if I add everything together, where do I land? Where do I land? So if I add this plus 149,400 plus 200, it gives me 514,600. 514,600. Yeah, is there impairment? The carrying amount is what? 500, and the RA is what? 514. The carrying amount is not greater. It is not greater than this, and it means that there is no impairment. It's tricky when you think there is impairment and you realize that there is no impairment. So it means that this one is the one that will go to the SOFP. Nothing is going to the P&L for impairment losses. However, you will be getting depreciations to the P&L. All right, so that is that. This is very, very interesting. But you have to work your way to find out. All right, if you don't work your way, you can't find out. All right. So, ladies and gentlemen, this is it for impairment. You have so many questions, and let me use this opportunity to actually do this. So you see this manual that I'm using is a manual that I've prepared, and it is good that if you are writing corporate reporting, you can actually have it. So you could see the contact here. All right. So you can pick it up and you can call me. All right. You will get your copy. So this is how the book looks. All right, so this is it. It's corporate reporting. So you have it. It teaches you the concept. It also has past questions, all the past questions on each and every individual standard, and for consolidation, for your ratios, for your business valuation and reconstruction, your ethics, they are all there. So the questions ranges from the FR level even through to the CR level, so that you can practice and get a deeper understanding. All right, so that is that. So if you see this book in town, then yeah, that's it. That's the book that I have done for you. It's to make your job very easy in passing your corporate reporting. All right, so that is that. I have other books, plenty other books. The taxes there, financial reporting kit, which has ACCA and ICAG past question. Even the corporate reporting too has some ACCA past question, and places where I believe that the examiner normally visits for questions is there. So some of the exams that have been written, those who have had the book actually had some familiar questions to actually deal with. So your principle of taxation is there. Your financial reporting study kit, and the audit and assurance is there. Your financial reporting study text. So the difference between the kit and the text is that the kit is made up of full past questions, and Nigeria, ACCA, Ghana, ICAEW, some CPA. So you have all those questions inside. So as you practice, very, very good. And this one is the study text. So this one has the notes too in addition. And also it has the past questions. All right. So that is that. So basically, those are the things that you should get to know of. All right. So ladies and gentlemen, you can actually pick up this line and give me a call. All right. And I will serve you. Wherever you are, we do delivery. Even if you are not in Ghana, Alibaba can help you. All right. So DHL is there. Alibaba is there. All right. They can all help you. All right. So, ladies and gentlemen, try and link up and let's have a good time. I hope you have enjoyed this class. God bless.